Hey, good morning, folks, and welcome. So today, what are we going to talk about on this live presentation? We are going to talk about whether or not right now we are in a stock market bubble, or if we're in a bubble in general, led by AI stocks. What is the best way to evaluate where you are in a current market? Evaluate it historically. We're going to evaluate it in several ways. The first way we're going to do is just from a macro picture. Does the market environment and what's going on look like what has happened in the past, or the conditions of the past that have led to a bubble bursting and markets falling precipitously? The next thing we're going to look at is individual sectors. So we're going to look at, for us, because we're looking at recent history, what we're going to do is we're going to look at the top 10 stocks in each situation. So we're going to evaluate 1999, we're going to evaluate 2008, and we are going to evaluate today as a comparison. Okay. We're going to look at those top 10 stocks. And someone brought up something very interesting to me yesterday, which I'm going to address, which is PE ratios. That is something a lot of people utilize in order to evaluate whether or not they're in a bubble type situation. So we're going to do that. And then we're going to zoom in on the stocks that led the way in those bubbles. We're going to take an example, right? And we are going to have one, I'm going to separate one piece here, and we're going to take a look at Tesla in 2021, simply because that was probably the highest flying position I could find before the market breakdown in 2021. I think that would be good to look at. We are going to do that through fundamental standpoint, and we're also going to go ahead and just look it up very quickly on a technical in a technical manner, so we can see what it looks like from there. Basically, just evaluating a couple things. How high have prices moved? Have they gone out of control from a technical standpoint? Have they gone completely parabolic? The second thing we'll look at is trading activity. The one thing that happens in any bubble is trading activity goes through the roof, and that is usually due to market sentiment being just bananas, right? Everybody is in love with position. So we're gonna take a look at that, and then we're gonna come up with our own opinion of what we think the market is right now, and then we are going to we're gonna look at those three individual positions that led the way. Qualcomm. We'll look at Tesla from 2021, and then we're going to look at NVDA for today as far as AI goes. And we'll see if we think we're actually in a bubble right now, comparing fundamental and technical. I'm going to try to do this relatively quickly so that it doesn't take forever. And then finally, what we'll do is we'll look at one market that is separated from stock markets and a little more tough to evaluate compared to a stock market, because it is a different animal. But that is the crypto markets, naturally. I know everybody out there that trades crypto wants to hear, well, how does crypto measure up in regards to these bubble scenarios? So let's go ahead and take a look. Let's get started. So what we're going to evaluate is 1929. When we look at big bubbles, right now we're going to evaluate 1929 to 2008, 1999, and then today. So what created the crash of 29? What created the biggest bubble? Well, lack of regulation, concentrated positions by investors. So most investors owned like the same 10, 20 stocks. So as those stocks began to roll over and people started to sell them, it yanked the indexes down. That lack of regulation, sentiment extremely high, right? Roaring 20s, sentiment extremely high. Everybody was in the market. Leverage back then was 10 to 1. Okay. So you could carry a lot of leverage. 10 to 1 is immense. Today, it's only 2 to 1. So we had lack of regulation, concentrated stock positions. No one paid attention to risk management, leverage, and obviously there was geopolitical events taking place, right? So there was a pretty big war starting, and we had just come out of a pretty big war, and there was a lot of turmoil around the globe. How does that compare to 99? Well, as far as leverage goes, obviously there's a giant difference in those two stock markets. They were 10 to 1 back in 29. We're 2 to 1. So I would say that that wasn't very comparable. You take a look at regulation, we're far more regulated today. I would say that's not comparable. 99, I wouldn't say, there was a lot of geopolitical turmoil or political turmoil on a kind of localized basis. Concentrated stock positions, yes, we had that. We did have that. Everybody was tech heavy. I mean, let's face it, that was the issue, right? So are they similar? Aside from the concentrated positions, not really. If you move into 2008, I would say lack of regulation was similar in the sense that there were just so many products tied to real estate that no one understood, and they weren't really regulated. And I don't really know if anyone truly understood those products. There was a demand for real estate, so sentiment in that particular sector, yes, was very high. We were regulated in general. We also have a lot of circuit breakers now that they didn't have in 29. So I would not say that those two markets were similar, aside from the fact, because it wasn't even so much as concentrated positions. It was just the sentiment within real estate was so high that everybody wanted a piece of it one way or the other. And then financial institutions jumped in because they're the facilitators of market action, and they create all these products that no one understood. And we definitely had a trickle down effect. It was the real deal. It was definitely a global economic crisis, without a doubt. You zoom into 2021, none of those things really are appropriate. You zoom into today, what can you attach to those two particular bubbles? Well, is there extreme market sentiment right now? I would say people are pretty excited about AI. I would say yes, they're pretty excited about AI. What about lack of regulation? No, there's probably more regulation in stock markets than ever. What about leverage in the market? Well, it's again regulated. I mean, the most you're going to do in the traditional markets is 2-to-1. You do have other vehicles to add a lot of risk if you'd like, and they are popular right now. That's options markets and futures markets. And, those are arguably 100-to-1, depending on how you sort of do the math. But they are more technically, you need to be more technically proficient to be operating within those vehicles. They move faster, so they're moving a lot faster than the market. And then they have their own specific risks, right? They have their own specific risks. But you can throw 1,000 into the futures market. Sure, you can turn it into 100,000. But hypothetically, if the S&P goes down to zero, you could owe 90,000. I don't think a lot of people know that about the futures market. The options market is, it has time decay, right? Time decay meaning you have to be right, and you have to be right now in options. So we have that kind of risk element, I suppose, in today's market. And there are a lot of people using those vehicles now. So I guess we'd have to recognize that. Deregulation, geopolitical events. Yes, we do have that going on right now. There's a lot of things happening around the world. Is it more so than ever before? I mean, it's certainly not World War II. We certainly did not come out of World War I. World War because the world was at war, right? So no, not in that regard. So let's take a look at PE ratios. That is something that a lot of people talk about. So I think it's fair to say that 2024, from the standpoint of 1929 or even 2008, where the world's largest financial institutions were almost a driver. They were a facilitator, but a driver. They were giving the ability for everyone to participate in this hyper excitement about real estate. Is that going on today? No. So I think it's fair to say from that standpoint that we're not really in that position today. Is there an over concentration of positions today? There was in 29, there was in 99, there was in 2007, 2008, and yes, there is today. Right now, it is obviously tech, and leading the way there is AI. So we do have that one piece that probably is reminiscent of previous bubbles. Now, let's go ahead and move on to PE ratios. Or actually, let's hold off for a moment. Let's jump over and let's just do a quick evaluation, a technical evaluation. We're going to look at price and trading activity and see what we think about that. As far as we can't go back to 29, We can take a look at 99, but it's not so relevant either, simply because the NASDAQ really just came to be. So it's not gonna give us a lot of insight. But let's just quickly, this will take 2 minutes. Let's jump over there and take a look at what we think from a technical standpoint, as far as trading activity and price. Does today compare to 2008 and 99? We'll take a look, but it won't mean that much. Let's go here. Here we are. So I'm just going to pull up a monthly here. This is 99. As you can see here in the back, if I scroll forward to 99, this is a very difficult thing to evaluate. There's just not a lot of information. But let's go ahead and take a look at 2008, which here we almost in 2008 we want to look at the S&P 500. This was the leader as far as indexes go into that bubble. So it's going to have more relevant information, right? It's going to give us a better picture of kind of what trading activity looks like coming into a bubble scenario. So here we are. We're back here 2005. You can see at the bottom. We're just going to scroll forward very slowly. And so we can see down here at the bottom is your volume, all right? This is your price. What we want to look at is volume, because this tells us how much trading activity is occurring. And what you look for in bubbles is high levels of trading activity, because that lets you know that the general public is most definitely involved in what's going on. So are institutions. Everyone's involved. It lets us know about sentiment and if we really are in a high level of excitement. Okay, so here we are 2005. If you watch the bottom, you'll sort of see the years. Here we are 2007. Now, take a look what happened in 2007. Look at the trading activity that occurred in, what month are we in here? Hold on. It is August. So we're in August of 07. Look at that. Look at that. This bar right here, that is the trade. That is what happened in August of 07 at a very, very high price. And in fact, at a previous market high. This is your number one indicator. Right now, red flag just goes up from a technical standpoint. Let's move forward, and it continues. Look at this. It continues. Now we get the market starting to pull down. Oh my goodness. So this right here, if this does not paint a picture for you right here from a technical standpoint that you are absolutely in bubble territory, nothing will ever paint that picture for you. You will never see it coming, because this is outrageous. This is what you look for right here, folks, all the way to the bottom right of that screen. That is what a bubble looks like. That is how you identify it. So let's scroll forward and watch how a bubble plays out. So that is immense trading activity, because you're comparing it to back here. Look at that. I mean, I need to say no more. And as we move forward, watch what happens as a bubble begins to drop. What will happen is retail will become more fearful, while strong hands, big money, institutional money was selling back here when they saw market sentiment. Sadly, it's typically retail or less knowledgeable, the less educated investors that buy. So as it falls, watch this. This is the bottom, everybody. Look at this. This right here, in here is your bottom. Look at the level of trading activity there as compared to the highs. The highs almost don't even look like they matter anymore. That's what it looks like when you reach the bottom of a bubble. Look at that. Okay, now let's scroll forward to today. The S&P is not what we're gonna zoom in on for 2024's evaluation, simply because it's not leading the way. But as you can see, there's certainly no bubble going on here in the S&P 500. I mean, if you're afraid of a world economic event right now, I'm not quite sure what you're looking at. Let's go ahead and back it up and just look at the NASDAQ, so we can make the same determination. Again, in 2008, it's going to look a bit different. Why? Well, first off, you have price behind you in 99, up at levels that we don't see again until the year 2017. That again is a bubble. When a bubble occurs, have fun. It'll be 20 years before you see those prices again. But let's go ahead and move forward anyway to today. So this is 2008. The NASDAQ participated, as does everything when there's a market bubble. It will suck markets down. Let's look at today. I'm going to move pretty quickly here because, as I said, there's nothing here to indicate a bubble from a technical standpoint. So from a broad perspective, if you're looking at 1929, 1999, 2008, and today, there is just no technical indication of a massive bubble going on. There is also no fundamental indication of a massive bubble going on from what we've looked at. From a macro picture, there is no indication of a massive bubble, right? That's what it is in the U.S. markets. Now, let's go back and let's just zoom in on today on a weekly chart for the NASDAQ, because that too will give us a bit of a better view of today. And you can certainly see how the market top was identifiable in 2021. Right here, volume trading activity was about 500%, the average. This was in November, and it led into December. This is holidays, folks. This is when market activity drops to about 50% of its average. Here, it was about 500% of its average. It was identifiable. This is a market correction, not a market bubble, as we just looked at. Is there anything today to signify a market correction approaching? Believe it or not, low trading activity is also, as far as a correction goes, is also something you want to look for. But for today's discussion, let's simply just say we're looking at bubbles. We don't see one. I think that's a fair assessment right now. Let's shoot back over. We don't need to share this any longer. So let's shoot back over here. Now, let's talk PE ratios. A lot of people talk about PEs in bubbles. What are traditional averages for PE ratios during bubbles? Well, in 29, they're not comparable, simply because you didn't have the level of participation, the number of stocks. We're going to ignore those ratios. They don't make a lot of sense. When you look at 99, you are looking at the NASDAQ at about 34. The average PE of about 34. When you look at 2008, it was less than 30. When you look at today, it's sitting at about 31, a little over 31. So 31 and 34, they are pretty close if you look at it from an average standpoint, okay? What we want to do is we want to determine if AI itself is artificial intelligence in a bubble right now. Is it leading a tech bubble? Let's look at the top 10 stocks in the NASDAQ. Let's compare 99 to now. That was a tech situation. This is a tech situation. Let's just take a look. So if we are looking at 1999, let me see here. Give me 1 second. I want to get the numbers accurate for you. So we're going to look at the top 10 in 1999, which is Microsoft with a PE of 79, Cisco at 100, Intel at 42, Qualcomm at 200, Sun Microsystems at 110, Oracle at 100, Dell at 57, Yahoo at 100, Amazon at 1,000, and Nokia at 70. What are the top 10 positions today, and what are their PEs? So we have Apple at just about 32. We have Microsoft at 34. We have Google at 28. We have Amazon at 60. We have NVDA at about 82. We have Meta at 24. We have Tesla at 45. We have Broadcom at 22. We have ASML at about 33. We have Costco at about 35. Well, I would say there's an incredible difference between PE ratios of 99 versus today. Our highest PE today is at 68. The highest in 99 was Qualcomm, or no, it was Amazon at 1,000. Then Qualcomm at 200. Amazon was a giant outlier back then. But as you can see, it's not that the bubble was wrong. It's just that people were too excited. That's what a bubble is. It's excitement. It's sentiment. It's is this the, is this everything? Is this going to change the world tomorrow? Kind of attitude. Okay. So Amazon got to 1,000. Are these PEs comparable? they're not. Now, you do have to take into consideration the fact that we have a crypto market over here that draws a lot of money away from stock market. We also have more products. We have people in futures and options. So I would not expect PEs to get as high as they had in the past. Is there still a divergence from PE ratio now versus back then? Is there a difference in market sentiment back then compared to now? I would say yes. And the price movement also will give you an indication of that. So let's just take a look at a few stocks and where they're at as far as their PE goes. We're going to look at Qualcomm because Amazon was such an outlier. Let's go to Qualcomm. We'll look at Tesla, and then we're going to look at NVIDIA. NVIDIA has a PE of 82. Tesla in 2021, believe it or not, was at 352. So even with all these other markets and all these other tools, you can still hit 350 as a PE when market sentiment is extremely high. And that's why I wanted to talk about Tesla. Then we'll look at Qualcomm. Let's take a look at what their price did in those 1 year. Like, how high did they rise in that 1 year to get to those PEs? And is NVIDIA in that situation now because it's leading the way? Let's take a look. All right. So first we'll start with Qualcomm that had a PE of about 200. Let's go back and just look at, let's take us to a monthly, just because it'll give us an easier view here. So let's get to January of 99. So January of 99, here we go. What is the price? As you can see up there, the closing price is at about $4, $4.11. How high did it get in that year? There we go. January of 2000, you can see the closing price of 63. So from $4 to $63, it had a high price of 100. Wow. So 25 times, right? At the high price, and a closing price at 15 times. It made 15. So your investment was up 15 times whatever you put in as a closing price. And if you got out the very high, it was at 100 times. I actually, believe it or not, do know a few folks that in San Diego that worked at Qualcomm that they cashed out their options there and, made anywhere from $50 to $100 million. Luck, and they'll tell you, but still pretty amazing stuff. So 15 to 20 times for Qualcomm during the 99 bubble, and that got them to a PE of 200. Let's go ahead and take a look at Tesla because that will be the next market area. So we take a look at Tesla. We're going to look at this on a weekly. Just that monthly looks terrible. It's too small. So let's go back to what? We'll go to January of 2020. We can see Tesla at $32 roughly. We have a high price of 33. Just call it $32. It runs from January of 2020 to November of 21. Let's call that 2 years. So it took twice as long. And the high price is 414. The close is 407. So the high price and the close are much, much closer than they were with Qualcomm. And how much did it go up? Well, from 30 to 414, you're looking at what? 13 times? So 13 times to the peak. Now, to the peak and to the close are really, really close. So while there was extreme market sentiment in Tesla, what you can see is it stayed at this level. This is November of 21. It stayed here until you're still there in April of 22, May of 22. Why? Because that is actually institutional money selling. That's big money, more knowledgeable money getting out of Tesla. Getting out of a position takes time. Getting into one can happen very rapidly, especially when you want to push price higher. So Tesla wasn't even necessarily a bubble. It actually played out like a typical position. It did get to earnings per share of 352, well above Qualcomm. It did take twice the time, but it had legitimate buying at the lows and it had legitimate selling at the high. Makes it quite different. Just to give you an idea of what a stock like this looks like, let's go ahead and take a look at NVIDIA today. This is NVIDIA. So let's go ahead and just look at what? October of 22. In fact, we can even let's get to where's May? Here's May. Let's look at 1 year in NVIDIA, okay? So we have a close of 286, 285. We can look at it. Let's look at it from the low because we'll call this the point at which it takes off. We're looking at it from the low. This is October of 22. We have a close of 120. So let's call it 120. Right now we're at 1130. So it's at 10 times its price. Do we see excessive volume at highs? We do not. We don't see excessive trading activity. PE right now, it says it's at about an 82. Doesn't compare to 200. Doesn't compare to 350. The market right now is in what you would consider an average PE of, say, 31. Does this facilitate a bubble to you? When I look at this, I would have to say no. I would say that NVIDIA does not look like bubble territory yet. Would I say that I would say this is business as usual, if I were to be fair? And I would say that for the market in general. So the market in general, as we looked at it, was business as usual. Here, we can stop sharing this now. I would say that the markets seem to be business as usual. We are at a high PE. We're not looking for corrections. I'm not telling you there's not a correction coming. What I'm telling you is it doesn't appear that AI is in a bubble. From a standalone basis, it does not. The markets do not contain the leverage that they used to. We are regulated. PEs don't appear to be anywhere near where they were in previous bubbles. Market sentiment doesn't appear to be anywhere near where it was in previous bubbles. We don't have the trading activity. So would we be in a bubble territory now? It looks as though the answer to that question is no. So we looked at it from the standpoint of PEs. We looked at it from a technical standpoint. I think we can all conclude that we're not in a market bubble as far as AI is concerned. And as a market in general, it would appear that we are not. Now, let's go ahead and talk about our final kind of piece of this conversation, which is cryptocurrency. What does it look like right now? Why are people calling cryptocurrency a bubble? Well, let's talk about it. Cryptocurrency is almost zero regulation, okay? Almost zero regulation. Transparency is thin at best. The leverage involved in crypto can go as high as 100 to 1, okay? So far beyond the 10 to 1 of 1929. Market speculation is all that is going on right now is effectively speculation. So that is not good. Geopolitical events, do they affect crypto? Certainly. Everybody's talking about currencies right now, currency wars, et cetera, et cetera. Does it have the definition to be a market bubble from that standpoint? We obviously can't look up PE ratios. We obviously don't have enough history on crypto. We can look at a technical standpoint, trading activity, if we want to break it down to, say, Bitcoin. And why don't we do that? Because from a macro perspective, crypto is absolutely in bubble territory from those standards. So let's go ahead and take a look. All right, here we are. Oh, wait. There we go. So let's take a look at crypto from let's delete this, remove. So again, with crypto, the difficulty here would be the way price has moved, right? Let's back it up. So here crypto comes into existence. Really, it comes into play somewhere around 2014. As you can see, you have the typical hype. You can see trading activity here going through the roof. What you also do see is trading activity kind of go through the roof as it comes back down in 2015, 2016. Now, as we approach these market highs, once again, let's see, move it forward so you can see dates. there we go. 2017, 2018 is activity at the levels down here in 15, 16, and 14. I would say no. You move it forward. What about these highs? This is just a ginormous chunk of volume. What's gone on since? And volume being trading activity. It looks like you have significant trading activity down here in 18. We're running back up now. Is there anything here to say that trading activity has picked up or fallen off or, anything along those lines? Ugh. Gosh, I mean, if you're looking for bubble type territory, this is a real difficult one to evaluate. Why, everybody? Tell me why. Someone point out to me why this is so difficult. Well, I'll tell you why. When you have prices back here at 964 and you have prices today at 70,000, it doesn't quite take the trading activity to do a proper evaluation now, does it? But let's take a look at the activity from here. This is the activity of 2021. This is the activity of later in 2021. And here's the activity levels. Has activity in Bitcoin, because that's all I can really pull up, has that really increased all that much directly? It hasn't. But now we have other markets like ETFs. So evaluating this from a technical standpoint is very, very difficult. So I'm not going to attempt to do it. It doesn't make sense. I can't even see all the activity going on, right? There's so many mixers. Now you've put ETFs into the mix. And by the way, the introduction of what you would call a derivative to the actual market is a giant indicator to a bubble. The widely used derivative is another and I mentioned that, right, in the 2024 bubble scenario, that is a widely used product and newly used product traditionally when we're in bubble territory. I would say that crypto has every indication to be in a bubble territory. And if you are involved in crypto, you saw what happens to bubbles. Okay. Qualcomm, let's go back and just look at that price action real quick on those three stocks. We know markets in general tend to fall 50 to 65% when bubbles burst, but individual positions, we know in crypto tend to fall about 90%. So we don't even need to do that evaluation. Tesla fell 75% in 1 year after its market climb. Qualcomm fell more, obviously, in 99. And is NVDA even in a bubble right now? Is it parabolic? Is sentiment through the roof? Is trading activity through the roof? It doesn't appear so. All right. So I believe that's everything we were to cover today. Thank you so much for tuning in. As always, make it a great day. If you're having a tough day, if it feels like things aren't coming together, they will. You have to have faith and put that fake smile on if you need to till it becomes real. Every day above ground is a good day. If you do have any questions on this, please don't hesitate to ask. Also, I am beginning my VIP mentorship program here on June 5th. I'm going to go ahead and put that up. I'm starting June 5th. What do we cover? We cover the essentials of doing what I just did for you, right? But we zoom in and we look at it much closer to today. We look at investment management. We look at cash management. So what's investment management? Where should you be invested? What's cash management? How much cash should you be holding? And then we look at risk management. How much risk should you be hedging? And how much participation should you be having? If you have those three pieces, those three pillars put together in the right way, I promise you, as long as you are evaluating on a consistent basis, then you will have consistent returns, and consistency what actually leads to wealth creation, not giant returns. You want to keep that standard deviation as small as possible, right? You don't want to deviate. You don't want big swings up. You don't want big swings down. That's why I'm always evaluating risk. And at high prices, folks, it doesn't matter that if you don't believe there's risk. As we just went through, I don't believe we're in a bubble. This doesn't appear to be any world economic event that I need to be concerned about. We are, however, at an intermediate high price. So I'm always going to challenge the bull market, because as long as I'm challenging the prevailing wisdom, the prevailing stock market price and action, I am making myself bulletproof from getting caught by 50% drawdowns. That is exactly what we go over in my mentorship course. It's a 6-week live course. We do 2 educational events a week. They're about an hour long. Sometimes they go a bit over. They're recorded, so you have access to them every day moving forward for the rest of your life. I also do 2 to 3 hours of Q&A a week so that you can ask me any specific questions. You get a live market update at the end of every week and before the beginning of the coming week, so you can see what happened in the markets through my eyes, above and beyond our 2 hours spent covering education and our 2 to 3 hours covering the Q&As with the group. So you have a chance to learn from your peers as well. That course is starting on June 5th. If you're interested, please reach out. I only allow 10 spots in these live courses because I want it to be very interactive. Truth be told, the length of time is really based on the people in that group and the questions that they have. If you have additional questions, I would, when we need to go over time, I pull you aside and I go over those questions with you. So as long as it's reasonable, right? But if you need an extra session a week, I'm happy to do that. Thank you all so much. Have a blessed, beautiful day. Remember, it's all about challenging your current opinion. That is how you protect yourself. Risk management, cash management, investment management. I will see you tomorrow.